TD Cowan has come out with its latest Canada Best Ideas report. It is a compilation of investment ideas across TD Cowan's Canadian coverage universe. There are some interesting ideas, not only on specific stocks, but also on some of the big macroeconomic themes for Canada. Here to tell us all about it is Andre-Philippe Hardy. He is head of Canadian research at TD Cowan, and Andrew Kelvin, head of Canadian and global rates strategy at TD Securities. It is lovely to have you both here.
Thank you for having us.
I was going to say, I think it's been about a year and a half, or a year at least, since I know I've had you both here. And I know lots has happened. So maybe tell us what's happened.
Yeah, I think if you go back to about a year ago, first of all, we've increased our coverage. We have resumed coverage of Canadian midstream companies and Canadian utility companies. And in the U.S., we have grown in banks, in auto parts, in utilities and midstream companies. So our coverage has grown to about 1,300 securities in North America, which is quite large. And more importantly, what we've seen is the benefit of the two firms coming together. We are seeing a lot more integration between Canadian and US analysts in day-to-day reports and collaboration pieces such as the ahead of the curve work that we publish, as well as our conferences. And having a north-south view is very important if you think about the makeup of large Canadian corporates, which all compete in the U.S.
The north-south world, yes.
Exactly. And what's been exciting recently as well is we have combined the strategy team with the research team, which was making collaboration even easier, as you see in the piece that we just put out a few weeks ago, which was really a collaborative effort between strategy and equity research.
Yeah, so bringing both sides together.
Absolutely, and it's been a real pleasure working more closely with Andre and his team.
Awesome. All right, well, let's get into some of what this research is. As someone who is one of the consumers of all this research, it's awesome because I just love seeing the deeper and broader coverage that I'm seeing in terms of for Canadian equities as well, too. This is the Best Ideas report that's come out, and you talk about the Canadian economy, and you talk about what it's facing and some of the headwinds as we go forward. You highlight three core areas or three themes, risks, however you want to say it. But tell me what they are, and tell me to give us a little background on where and why you're concerned.
Yeah, sure thing. So the three core themes we identified were around obviously the changing Canada-US trade relationship, around the potential for significant changes in fiscal policy and Canada's fiscal stance in the upcoming budget, and around sort of the ongoing impacts of Canada's changing demographics. We obviously had very big changes in immigration policy that came through over a year ago now, but they're really starting to leave a mark on the economy. So those are the three things we identified. I would say of the three of them, obviously front of mind is the Canada-US relationship. That has made this a rather tumultuous year. And it's interesting, even though we are all the way into the fall now, the data is still noisy enough that it's not entirely clear that we still know the full extent of the impact of this changing relationship. Having said that, cracks are starting to form in the economy. We've seen some really sharp weakness in the labor market in recent reports. Yep. Business investments fallen off, which is why we kind of came to the notion that the title of this for our piece should be Living on the Edge, because we really are on the precipice of a potential recession. Yeah,
and when you say noisy, I mean, there couldn't be a bigger understatement. It's like it's deafening how noisy things are in terms of news, markets, data. So trade core, in terms of understanding, what's going to be the future, what that trading relationship looks like. What about you highlight fiscal stimulus as well too? And we coming on the theme of we're getting into nation building now. Whenever you say nation building, there's a price tag attached to that.
Yeah, it's I think some very well-intentioned and productive efforts to try and improve Canada's productivity. We have for my entire life spoken about Canada's poor productivity issues. Mm-hmm. I think a very simple approach to try and fix some of these things is to make it easier to build things in Canada, to improve our critical infrastructure, to help make it easier for Canadian businesses to invest in machinery and just get things done.
Right.
To put a very unnuanced take on what is a very large sort of and complex platform document, the government seems to want to make it easier for Canadian businesses to get things done.
Which is great.
Which is great. I think the way to think of these things is as investments. If these are good investments the government makes, they will pay off, Canada's productivity will increase, and they will pay for themselves. If they are poor investments, they won't. And to be honest, that's really a question for 2026.
Mm-hmm. How do you, and I guess in terms of, from the the economic standpoint, you have here listed as one of the themes on fiscal stimulus is just the idea of removing internal trade barriers. How does that play into the stimulus side of things?
So these are theoretically costless productivity enhancing measures.
Right. Unlike the rest.
Exactly. Those will have costs.
Yeah.
It's something that people have talked about for years and years in Canada, the difficulty of trading east to west. We have a very north-south oriented economy. Given that they have this changing relationship with the United States potentially, it makes sense to perhaps revisit some of these east-west relationships and try and improve capital mobility, labor mobility, flow of goods and services across provincial borders rather than focusing solely on the U.S. border.
Last piece you talked about was demographics. So maybe tell me a bit about that and what you're seeing from a Canadian standpoint.
So we've seen population growth slow to essentially zero.
Yeah.
It's slightly positive in the second quarter, but slowing to essentially zero. It's going to structurally change the way the economy functions, going from what was a very high population growth economy to a negligible population growth economy. It will hopefully incentivize businesses to focus a little bit more on investment rather than just focusing on increasing labor input to try and deal with problems. It will have negative impacts on things like rents and the housing market. I think you can look at a lot of the sort of sluggishness in the housing market we've seen. That isn't really an interest rate story from my perspective anymore. Interest rates are at historically normal levels. I think we can look at this in part just as the fact that demand for shelter has changed. It's a great unknown. It's a great experiment. We've never had population growth fall to these sorts of levels in Canada for prolonged periods of time. And it's going to be, honestly, somewhat unknown how that's actually going to ripple through the structure of our economy over the next year or so.
How is this going to net out from a, when you say living on the edge, from a, just to give us the big picture of your outlook, GDP growth and currency? Where is that going to, how does that play based on what we know today?
Certainly. So the way we're thinking of all these shocks is when you add fewer people to an economy, nominal GDP growth falls. That's arithmetic. The trade shock is a very clear negative, and it should be a front-loaded negative. It should be something that is having impacts on the economy today, last quarter, next quarter. So we see it something that really drags on 2025, and we think it'll keep growth somewhere around zero for the second half of this year. We have it slightly positive, so we don't quite have a recession in our forecast, but it's going to be pretty close to 0% growth in the second half of 2025, we believe. Fiscal stimulus, probably more a 2026 story. We expect a budget on November 4th. And that should give a better idea what the roadmap is for 2026. But in our base case, we do have a decent recovery in economic activity next year, helped along by a healthy dollop of government spending.
And currency, what are you expecting?
We have a little bit of a depreciation in the US dollar in our forecast. Right. I think you can very simply look at the current currency landscape as one where the US dollar has been outperforming versus a variety of currencies for a long period of time. With the Fed now normalizing its policy rate, the US dollar should depreciate. So we have the Canadian dollar appreciating by sort of 1.5 cents into the end of this year and another sort of 2 cents into next year in CAD dollar terms.
You know, we just heard from Andrew in terms of what he sees happening in the economy. Granted, a lot of your ideas here don't just function in the Canadian economy, they function in the world economy, but how do you incorporate what you've heard into how this gets put together?
Yeah, as Andrew described, there are a lot of challenges over the next 6 and 18 months in the Canadian economy, so it's no surprise that when you look at the 25 best ideas in this report, many of these ideas will have company-specific catalysts or low direct exposure to trade or exposure to macro themes such as electricity demand and what AI means for all that. So that's how a lot of that outlook is incorporated into the best ideas.
Interesting. And I have to say, my favorite thing is what is underappreciated or misunderstood in every report that you have out. Let's start with the first best idea, Brookfield. Brookfield Corp, to be specific. Why this one?
Yeah, Brookfield Corp is one of the largest alternative asset managers in the world with almost $1 trillion in assets under management. It's across renewable and transition. It's across infrastructure, private equity, real estate assets. It's very, very diversified. And the company has delivered an incredible track record. You know, annualized returns have been 20% or so for the last 3 decades. And we expect that long-term trend to continue. So just in recent weeks, the company outlined a plan to double over the next 5 years at an investor day in New York City. And there's really quite a few things driving that, but I'll just flag a couple and go with that. So first of all, like Brookfield holds one of the world's largest renewable power portfolios, and it has an industry-leading franchise in infrastructure and real estate, which are all positioning the company to play a significant role in the build-out of AI infrastructure, which is a theme that we see emerging irrespective of what happens to the Canadian economy, of course. Another exciting aspect of the Brookfield story is what they're doing in diversifying who they sell to. So if you look historically, Brookfield, their bigger clients have been pension funds, sovereign wealth funds, and they're now expanding into the private market by creating portfolios that retail investors will be able to invest in, and we think that's going to drive significant growth for the company. And on top of the track record that I alluded to earlier, we really like the alignment between management and shareholders. Management owns about 20% of the stock, which makes us comfortable that they are making decisions that are right for all shareholders in time. Alignment is important. And
I just will say this piece here about the critique has always been for Brookfield is that it's a very complex balance sheet. And it's interesting you say that in the report that we disagree. 75% is the NAV comes from publicly traded investments, which of course are transparent. You can see them.
Exactly.
Next pick you have, I don't know if we're going capital or alphabetical order, but we'll see it this way. Capital Power Corp.
Well, alphabetical order, but you'll hear the theme of artificial intelligence again here.
Yeah.
So taking a step back, Capital Power is an independent power producer historically in Alberta. But it has grown well beyond that with about 57% of its capacity now in the US. And we believe Capital Power will benefit from growing demand for electricity, and it trades at an attractive valuation. So really 3 areas to focus on in terms of exposure to growth: Alberta, PJM, which is Pennsylvania, New Jersey, Maryland, and recontracting in general in the US. So starting with Alberta, we expect significant investments in artificial intelligence infrastructure over the next decade, and Capital Power is very well positioned to benefit from that directly and indirectly. And that demand that we expect to arise from growth in data centers is not, of course, unique to Alberta. It's also a key theme in PJM, where Capital Power completed its largest acquisition to date just back in June. So now about 18% of Capital Power's net capacity is in that area, and that is a very data center rich area, and we expect robust growth over the next decade in terms of electricity load. And lastly, one of the areas that we think Capital Power will benefit from is recontracting. So it has many long-term agreements that are expiring in its US businesses over the next few years, and we think there's a real possibility that some of these agreements will come early as some purchasers of power look to lock in supply for the long term, and that is likely to come at higher rates than what the company is currently charging.
We always talk about AI being the hungry caterpillar, just needs more power, right? So interesting.
Exactly.
I'm going to try and squeeze one more in, and this is AtkinsRealis. I think this used to be SNC, I think, back in my old days. So I was going to say, so tell me why this one is on the list this year.
Exactly. I mean, thematically, Andrew, and you talked about it a little bit earlier about the need to invest more in Canada, and as that happens, certainly that will be helpful to AtkinsRealis and other engineering companies. But there's really 3 things that drive our bullish view. One, it's a very compelling revenue growth outlook. 2, they have a lot of capital allocation flexibility. And thirdly, they trade at a discount to their Canadian peers. So on revenue growth, the company's engineering business has record backlogs, and that's driven by favorable demand for their infrastructure businesses, their power businesses, and their water businesses. And on top of that, their nuclear business is also doing incredibly well with record backlog and very fast growth in revenues. And on top of very strong revenue growth, we're also expecting margin improvements as the company has a lot of measures in place to drive margin improvement. So that should drive significant growth. But at the same time, there's a lot of capital allocation flexibility. So in spite of buying back a lot of stock in the first half of the year, the company has surplus capital, and going forward, we expect that to be invested in organic growth, but also some small and mid-sized acquisitions of engineering firms, which are typically well received by investors. And lastly, as I alluded to, the company trades at a discount to its main peers, which we just don't think is justified given the fundamental outlook.
Okay, we've got three really interesting names. We've got two more, and I want to squeeze them in. Boardwalk REIT is a name that I know is familiar to Canadians. Why is it on TD Cowen's radar?
Yeah, our thesis on Boardwalk is it's in the best markets in terms of fundamentals over the next few years, which is resulting in some of the highest operating income growth in apartment REITs in North America. More specifically, in terms of what I'm talking about in market fundamentals, Alberta and Saskatchewan now represent 73% of operating income for Boardwalk. And we like that exposure given relative population growth, less new supply coming on, and lower in-place rents.
That makes sense, just to put some context around this. The provinces that are really exposed to the demographic changes, because those are all around temporary residents being restricted from joining the economy. That's a BC Ontario story more than it is a prairie story. It affects everyone.
Yeah.
But those are probably less impacted.
Prairie's being more stable.
Yeah.
Yeah, not as much inflow. Interesting.
Yeah, absolutely. And on top of that, financially, Boardwalk has by far the lowest payout ratio of any apartment REIT in Canada. And it's therefore funding all of its capital expenditures and distributions from operating cash flow. What that really means and how that has shown up is since the end of 2022, they've grown their average net asset value on average by 14% a year, while their peers have been flat. So it has had a tremendous impact on net asset value growth, and also they've been able to reduce their leverage faster than peers over that period. And in spite of all that, they trade at an average valuation relative to the peer group.
Interesting. All right, let's squeeze one last one in, getting my value for my money here, Andre. Gildan.
Yeah, so we think the proposed acquisition of HanesBrands by Gildan will be a positive for earnings per share growth and the share price in upcoming years. HanesBrands' retail strength and Gildan's industry-leading cost structure is creating a diversified industry leader capable of market share growth and in turn strong growth in earnings per share and free cash flow. We anticipate upward revisions in consensus estimates and the multiple for Gildan to gravitate towards its historical average. Strategically, what's great is you now have the U.S. industry leader in printwear, as well as the U.S. industry leader in retail innerwear with complementary product lines and a low-cost structure, which is positioned to, or a company that's positioned to gain share in both retail and printwear. There should be material cost synergies as the company implements best-in-class manufacturing, optimizes geographic production, geographic distribution, and vertically integrates some of HanesBrands' operations and consolidates some of the footprint. And there should also be savings from refinancing debt that would be at a higher cost at Legacy Hanes than it will be under the Gildan umbrella.
So this is just really they run it efficiently, bringing in more all the things, the distribution, but just running it better, as I would say, to squeeze out some efficiencies.
100%.
Yeah. I think I'm curious, and thank you for the names. They're so interesting. You know, these are, and I think what's interesting is the names, you know, you're choosing are in the universe of where you think what the world going to be happening in the world. But I'm going to ask you, is there anywhere world where you see things could be better than you're anticipating right now? I know you're an economist, and you know you're one of the dismal scientists, but I'm going to ask you to be optimistic for a second.
Not only am I an economist, I'm also a fixed income person, which is another thing
another
that
blow.
tends to create people, create pessimists, let's call it. So I'll just highlight one thing that I've been impressed with in the Canadian economy from the data we've had thus far, which is there's been more resilience in household spending than I would have anticipated, given all the uncertainty, given some of the hits we've seen in the consumer confidence data. Household spending, even the second quarter, held up pretty well. And one of the interesting changes in the Canadian economy that really occurred during the pandemic, and I suspect I'll be talking about during the pandemic for the remainder of my career as a thing that changed the structure of the economy. Canada transitioned from being a very low savings rate country to actually quite a high savings rate country.
I heard a stat, and I think I was talking to one of your counterparts in TD Economics, who said that the spending rate of Canadians in the last quarter was like 2.5 times the rate of Americans, because with the elbows up spending and with vacations and things like that.
It was a really strong quarter for household spending, absolutely. The fact that we have these sort of cash buffers within the system because we've transitioned to being more of a high savings rate economy, and we haven't seen household spending totally fall off, does give me some optimism that perhaps some of the more negative forecasts out there may not be realized. And it's not to say there's not pockets of pain within the household sector. that pain's just not universally being felt right now, which can help provide a little bit of a buffer to the economy that perhaps some people aren't as aware of.